Welcome back to EDS, and in this video I'm going to show you how you can get consistent returns with low risk writing options contracts. So the first thing you want to do is just pull up any equities underlying. Um, let's just use Netflix like so. And we want to navigate over to where we can see a list of expiration dates for the underlying. Now, the one that we want to choose needs to be between 30 and 60 days out in time. And it also needs to be a weekly, not a monthly or quarterly expiration. And the only expiration date that fits that criteria is January 17th, which is 32 days out in time. We are going to be writing contracts or selling contracts. Those terms are interchangeable. The first thing that we're going to do to minimize risk is simply filter out any and all underlyings that have earnings within the next 32 days. The reason for this is because earnings will increase volatility, it will mess up our deltas, and this will have a negative effect on our P&L. Remember, we are writing options contracts, which means our P&L is based on the value of the options contracts, not necessarily the value of the share price. So even if the share price of the underlying, that is. So even if price doesn't move anywhere but volatility increases, that can affect our P&L in a negative way. Likewise, if price doesn't move and volatility decreases, that will affect our P&L in a positive way. So we also want to filter out anything with a low liquidity level. The reason for this is because we don't want to trade anything that's going to be difficult to get in and out of, and we also only want to be paying tight spreads, not wide spreads. So at this point, we just go down the list and we see what would fit well inside of our portfolio. This is just a standard, basic, pre-made watch list. In fact, just to prove this point even further, it doesn't matter about what watch list you're using. Let's just use high options volume watch list. Any watch list is fine. We are product indifferent. I'm going to show you how you can take any underlying and turn it into profit. So regardless of what the price does, whether it moves up, down, sideways, doesn't matter. So what I like to do is order everything from high to low IVR. The reason for this is because, as we just briefly touched on, volatility plays a part on our P&L. The higher the volatility, the higher the options price. We're going to be shorting these contracts or writing these contracts or selling these contracts. All these terms are interchangeable. So basically going to be shorting the contracts, and then we hope to buy it back at a lower price later on or just let it expire worthless. So we want volatility to be high at the beginning when we write the contract, and then we want volatility to contract. Volatility is mean reverting, so if we sell when it's high, then we have good odds of volatility contracting and P&L going in our favor. So I like to order everything from high to low IVR, and you also want to keep in mind what's already in your portfolio. Okay, if you are very heavy in any one sector, try and go for something else. You don't need to get too fancy with it, but just use common sense to keep everything nice and diverse and lightweight. So just go down the list. We want to try and look for things that are trading for at least $40, $50 because that will help with our strike selection. And we want to be picking something with an IV rank of ideally over 50, but sometimes over 30, 40 can be okay. Coin is jumping out at us right now, trading at just under $323 a share. It has an IV rank of 65.7 and an absolute IV level of 85.3%, which all in all it doesn't look too bad right now. Obviously, there have been times where IVR has been higher. However, there also has been quite a lot of times where IVR has been lower as well. So hopefully, we can see this continuation of IVR going further lower. We don't actually trade based off of the chart. We don't look at price action. We don't look at any of these things. The only function of looking at this chart really is just to see where IVR is relative to itself. But it's kind of intrinsically tells us that anyway due to what IV rank is. So we know it's, in the sort of 65th percentile. Very similar to IV percentile. IV rank and IV percentile essentially does the same job. So we wouldn't even need to look at this, but just if you prefer to visually see things and see where price is relative to itself, by all means you can look at the chart. But we don't need to look at this. So coin. Let's just go over to our trade tab and open up the January 17th expiration date, and let's pull up the options chain. So this is the options chain here, and this orange horizontal bar shows us where price of coin currently is relative to the strikes, as we can see listed here, and the vertical orange bar shows us where the expected move of coin is over the next 32 days. And we have our dotted blue lines here that show us where these one standard deviation levels are. Now, we want to, as mentioned in the title of this video, we want low risk trading, right? Low risk strategies. So low risk to me means we want to be winning far more than we're losing, right? If for every 10 trades we win 9 and lose 1, and we only have to manage 1 out of 10 and worry about 1 out of 10, that's far easier and less stressful than having one big winner and nine losers. Hopefully they are small losers, but it doesn't necessarily always end up being that way. So it's easier to have a lot of winners and small number of losers that you can manage. So what we want is a high probability of success of this trade working out in our favor. Now we know what the expected move is, which is this bar here, the vertical orange bar. So we want to be selling our contracts further out from the bar. Okay, further out from the bar. And how much further out? So typically somewhere around the one standard deviation mark, because standard deviations, the way that they work is as long anything within a one standard deviation range is basically a one standard deviation range encompasses 68% of events. Okay, so if we would sell contracts at 400 and 250, we've got about a 68% chance straight away off the rip, just based on pure statistics. Our actual odds are higher than that, 74%, because we collect premium on top. And as we can see here, our break even, this green bar is our break even bar, which extends past our short strikes. So we get higher than 68% chance of success. But how do we be as capital efficient as possible? So we want to have a high win rate, low risk, but we also want to be making as much money as possible. So the way that we do that is by targeting anywhere between a 15 and 20 delta. Um, and this is our delta column here. So we've got a 19 delta here at the 420 strike. We've got a 21 delta. Let's just go to a 21 delta, which is closer to the one standard deviation mark. And we've also got a 19 delta on the put side. So as you can see here, this is the range that we've created for ourselves between 270 and 410. The contracts are outside of the expected move. Our break-even levels are far outside of the expected move. And as you can see here, we've got a probability of profit of 69%. And what that means is we've got a 69% chance of making at least a penny on this position at expiration, which is in 32 days' time. Now, here's a big secret. If we want to get out of this position at 50% of max profit, i.e., this is a premium that we collect, $17.55. If you want to get out of this position hitting 50% of that instead of the whole 100%, we've got an 80% chance of being able to do so over the next 32 days. So we're looking at between 70 and 80% chance of success depending on how long we want to hold this position. Now, these are some very, very high probabilities of success. Now, if you want to have an even higher probability of success, you can absolutely do that. You can just go further out, say 16 delta on the call side and 15 delta on the put side. We've now got a 75 and 85% chance of success. So you can play with this as much as you want, but as long as you're sticking to a maximum of about 20 deltas, you'll have a very stress-free time in managing your winning positions. Now, let's look at the numbers a little bit more. So we would collect $17.57 upfront per share. Each contract controls 100 shares. So that's 1,750, well, $1,745. This is constantly moving as the price is moving. But we would collect $1,745 in premium upfront. Okay. our broker would require just under $18,000 in buying power to be able to open this position. Now, you're probably thinking that's a lot of money, and you definitely don't want to be allocating that to one position. Even if you have got a larger portfolio, it's still a lot of money to tie up to one position. So, what you can do is simply just cover your short positions. Now, the reason why this is taking up so much is because we have an unlimited loss potential, as you can see here. So, if we define our loss, we just buy another contract a little bit further out from the short contract, and we can do the same thing on the put side. $10 wide on either side, 410, 420, 260, 270. That's $10 wide on either side. What that's done is now we've defined our risk. So our max loss is no longer unlimited. It's $690. How have we arrived at $690? Well, our risk is now defined by the spread in between our two contracts, which is $10, minus the premium that we collect up front, which is $3.05 or $3.10 now. So you take away the $10 minus the the $3.10 off of the $10 max risk. And what you end up with is $6.90 times by 100 because it's 100 shares per contract, and that's how you end up at the max loss. Now, the reason why you deduct the premium is because once you collect the premium, that's added to your cash balance. It's non-refundable. That's not to say that you know, if the position goes against you and you have to close out at a loss, you can end up paying more than the premium that you collect. So you can end up paying more, but the actual premium itself is non-refundable. You keep that and it goes to your cash balance. So that's why our break-even points extend past our short contracts, because once price breaches your short contract, it then has to go past the amount of premium that you collect. It's like a little buffer that you get. It's a head start that you get, as opposed to if you're buying these contracts, right? So, with that being said, we've reduced our buying power requirement down from $18,000 down to $700. Our broker knows what our max loss is, and so it's only going to require that much in buying power to open the position. It doesn't need more than that. So, $700 is much more manageable for most people and should be able to fit inside most portfolios. This is a very, very small portfolio that we are trading right now. We're simply using it for example purposes. However, if $700 seems good to you to use in your portfolio, this is a perfectly justifiable position to place. And once you place the position, you just let the odds work out. And you just keep the premium. You collect the premium. You can take profit at 50%, take profit at 25%, take profit, or you can hold to expiration. If things go in against you, you've got your risk defined. It's max loss. There's not really too much management that you can do because it's a covered position. However, you can always move the untested side up or down, collect more premium. You'll keep your risk the same, and basically reduce your max risk essentially. But that is outside the scope of this video. Now, how do you know how much buying power you should be allocating to your positions? Well, we've created a position sizing template that's free for everyone to get a copy of. Link is in the description. Just click on this button and it will take you to this spreadsheet here. The way it works is you enter in the size of your portfolio and then you enter in what the current VIX level is. And what will happen is everything below will be automatically calculated for you. And at this point, all you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to undefined risk positions, defined risk positions, and how much of your portfolio you should be allocating to short premium strategies in general. As long as you follow this, you will be absolutely fine over the long term, and you won't run into any issues causing you to blow up your account or anything like that. Now, if you want to learn in more detail, see what we're doing behind the scenes, again, link in description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. And there's also a full course, so no prior knowledge is required. We will teach you absolutely everything that you need to know from start to finish. This allows you to learn the theory and see it applied in action in real time in real portfolios. You can use our positions as inspiration, or you can simply copy us. It's up to you. It is a private community, so you can speak with like-minded individuals or with myself directly at any point for encouragement or help or anything like that. There's a 100% money back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. It's £1 a month to join. Price will be increasing. It's so cheap because we've just started it, but as we get more and more members joining, the price will be going up. Um, However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. The goal of EDS Premium is to get you completely self-sufficient to where you can write contracts, know exactly what you're doing without any external help or influence within about 6 to 12 months. Of course, you're always welcome to stay and be part of the community. However, um, 6 to 12 months is all you need, and you should be able to do this all by yourself for the rest of your life. With that being said, I will see you guys on the inside.